Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. The recent action continues, more or less, to be captured within the two explosive days range back in late February between 1579 to 1759. Since then, despite an initial but now defunct bull channel, the market edged lower in a 2 steps up and 3 steps down action, such that at the start of April we saw a test and breach of the support band 1579 to 1571, and prices briefly tested down to 1560. Now, this 2 steps up and 3 steps down action had left the door open for the late February to early April action to be a descending triangle pattern. A few things first before I go any further. This descending triangle is by no means a perfect example of such a pattern, but there are significant elements there that made the action look a viable opportunity. Next, we actually have two descending triangles, one within the other. One from late February until the start of April, with the recent drop to 1560 being a false break lower, and one from late February until mid-April, which includes the drop as part of its pattern. Finally, a bit of information about descending triangles. Firstly, descending triangles can break in either direction, acting as a topping action as well as a continuation action. This one in question has seemed to be a possible upward continuation action. Indeed, in general, descending triangles that see a market rising beforehand, such as we've had here, have something like a 6 or 7 times out of 10 chance of breaking higher. Hence, I have previously placed some targets on the top side. Initial primary potential target X on the top side for the smaller descending triangle pattern in the 1757 area, right where the 50% projected Fibonacci line resides. A fuller secondary target X1, a harder one, would be in the 1810 area. If instead we look at the larger descending triangle pattern here, we would have an initial target X2 in the 1780 area, with a secondary target, harder secondary target X3 in the 1844 area. These last two targets would tie in with something I've already spoken about back 9 weeks ago, and repeated since. I spoke about 3 simultaneous patterns I'd seen over the middle end of last year and going into this year. They are all bullish. They are a rounded bottom, a large cup with handle pattern, and a scallop pattern. To be honest, it's been a bit disappointing to see no real attempt at trying for any of these longer term patterns, or targets topside at least. You see, the rounded bottom still has a primary topside target in 1983, which is off the top of my daily chart right now. Next one is a large cup with handle pattern, which has a primary target in the 1910 area. Once again, this is off the top of my daily chart. Finally, the scallop pattern, or to be accurate, the ascending scallop pattern. This has a primary target in the 1836 area, until recently off the top of my daily chart, and interestingly the one I have the least confidence in, even if it is the nearest. You can see it labelled as target X with a question mark by the side of it. These are all, as I've stressed repeatedly, way out there, but as we've seen plenty in recent times, lots of things that are way out there can suddenly happen. All this is not unusual to anyone watching or listening to my commentaries. However, what we have seen over the last 3 weeks or so has not been a move higher, nor have we seen the market treating the break higher as a false break and turning prices back down sharply. What we have instead seen is a slightly lower but basically sideways action. Thus, this threatens all the descending triangles as patterns, and we may be following something else completely. Now, this may be in the form of a long in construction bearish pattern, or it may be in the form of a rectangle pattern. At this moment, I'm not sure which, if either, is undergoing construction right now. So, I would like to finish off once again on something I originally said in my annual review of soybeans made at the very start of 2022. Back then, I was only looking at longer term charts, and I quote, "One other idea I would like to, let's say, provisionally float by you, it is way too early on this, but it should be worth considering, is to look at the whole of the 2020 today action as a possible bullish halfway hesitation. In which case, we might have, I say might, with due deference here, we might have a possible target X topside in the 20 and a quarter area. I'll just repeat that, in the 20 and a quarter area. This is way up off the top of my long-term chart. And it might sound ridiculous now. Indeed, it does sound ridiculous. But it is what I see, and I'd rather say it and maybe look ludicrous and even laughable now than be silent and be confirmed as an idiot who should have said something should it come about. Anyway, this is a multi-month and likely a multi-year potential target X, so there ought to be plenty of time. Plus, it will all depend on what the market does when and if it reaches the 2021 high at 1667 and the 2012 high at 1789. And that's the end of the quote. This bigger picture idea, done at the start of 2022, is still there despite the recent daily actions. Chicago soybean meal. I said here 3 weeks ago that we had the potential for the late January day action being one of 2 patterns. Now, the second of the 2 possibilities was to look at the action through most of 2022 as a topping action, specifically a head and shoulders top with a split head. It's not perfect, but it is a workmanlike head and shoulders top. 3 weeks ago, the market breached and closed below the neckline, currently at 446.30, and triggered the pattern. Thus, a primary target X2 for the head and shoulders top will be in the 416.5 area, and target X3 in the target X3, secondary target, will be in the 390.5 area. This is a harder secondary downside potential target. Since this triggering event, the market has moved lower, down through the medium moving average, currently 438.40, and reaching target X2 late 2 weeks ago. Prices continued lower, down through the interesting 50% Fibonacci line of the October 2021 to March 2022 move at 400.50, but only briefly, as by then the market achieved target X2 in the 416.5 area, and the fall had eroded the bearish incentive such that the next move down to the secondary target X3 in the 390.5 area seems to be too far. A significant part of this erosion was the market's reluctance to test the slowly rising long moving average below, currently 392.20, and to try for the 50% Fibonacci line of the 2021 to March 2022 move at 389.10, just under target X3. The start of this week had shown some indecision on whether the move up was the right thing to do, with 2 sessions of indecisive spinning tops and 1 indecisive doji cross after Friday's interesting bullish opening long white Mariposa. However, today prices have punched up through the congestion at 413.30 and up to the next resistance at 422 even. Beyond this, on the upside, we have the early 2021 high and congestion area and highs from January and February last year at 433.5. However, the first real test upside will be the flatlining medium moving average, currently 438.40, and the nearby April 2021 high of 439.30. Thus, it seems as if the head and shoulders top has played out its hand right now, and wait to see what the next pattern construction will be. After this commentary, I will retire targets X2 and X3. Chicago soybean oil. Of all the Chicago soybean complex, the landscape of Chicago soybean oil and this daily chart has changed by far the most. Initially, after the change gap in March, the market worked its way higher, filling in the change gap itself. However, the previous all-time high back in 2008 at 72.67 managed to temper, though not halt, the rise until nearly mid-April. Indeed, the June 2008 high at 68.97, another relic from those days, stopped the subsequent fall. Thus, it was those 2008 levels that captured the recent market until mid-April, when the market punched up through the 2008-based overhead resistance and up to test the levels seen back in early March, and even higher. This was an extended rally that saw prices move up over the 50% projected Fibonacci line at 81.23, moving even higher until 3 weeks ago, when a bearish engulfing pattern, if only just, managed to cap the market and start a subsequent decline. The market tried to recover but suffered a blow over last weekend with a changeover gap that started a further drop. Prices are now resting on the first really significant level of support, and that's the flatlining short medium moving average, currently at 76.15. That is just above the 50% Fibonacci line of the February to April move at 75.24. And also the nearby mid-December 2021 uptrend, currently at 74.93. Last time I put forward some ideas on what patterns may have been developing at this time, or at that time. My favourite back then was to look at the mid-December 2021 today action being a very large bullish halfway hesitation. The reason for my favouring this last idea was something I had pointed out a few times before. It is a lagging indicator of three golden crosses over February and March that produced enough of an impetus that this bullish halfway hesitation pattern idea looked likely as a pattern. We had a possible target X for this large bullish halfway hesitation pattern in the 92.90 area. I knew then it was a hell of an ask, but I felt obliged to suggest it. Plus, just beyond that, we had the 100% projected Fibonacci line at 94.95. Well, this pattern is no longer feasible, and I will retire target X on the top side after this commentary. It all now depends on what will happen in the area of the short stroke medium moving average, the December 2021 today uptrend, and the 50% Fibonacci line previously mentioned. This will dictate what likely actions and patterns may be coming next. I will only ask you to be reminded of one thing, something I pointed out the last few times. In April, we had a monthly key reversal up. This is part of a longer term pattern, but it is still very, very noteworthy and needs to be reminded. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.